Hello and welcome to interest.co.nz. I'm Gareth Vaughan with another of our double shot interviews, and I'm joined by Sam Shuttleworth, who's Financial Services Partner at PWC. Welcome in, Sam.
Yeah, thanks for having me.
Good to see you again. Sam is here to talk about the latest Banking Perspectives report from PWC, which covers the second half year of the big five banks' 2013 financial years. So that's the big four Australian-owned banks plus Kiwibank. Now, Sam, you've noted in there that the performance of the big banks are echoing a number of indicators of the overall New Zealand economy and how it's performing. Can you just highlight perhaps what they are?
Yeah, sure. So looking at the results for the second half of the 2013 financial years, it's clear this is a confident result. If you look at underlying profit before tax, that's up by about $244 million to $2.7 billion. So that's 10% growth on the first half of the financial years. So again, very confident. If you then go through the numbers, we've seen slight growth in net interest income. We've seen improvement in bad debt expenses, so they're continuing to come down from those peaks in 2009. They're down 27 million to 178 million. That's quite a low number, and that's very much pre-GFC days. When you look at the lending growth that's come through, again, that's very important to see. The continuation of the lending to the household sector, but also the non-household sector, that's recorded a 2.2% lift from the first half of the financial year. And this is a fourth consecutive period of growth for the non-household. Again, confident corporate sector, confident business sector, confident household sector, and that's flowing through into the bank results.
Now, you've also highlighted that the big New Zealand banks are performing better than their counterparts in Australia in terms of net interest margins and their cost-to-income ratio in particular. Why is this, and can it continue? Yeah,
so when we look at the margins of the New Zealand banks versus the counterparts in Australia, the NIMs, net interest margins in New Zealand, they're around about 2.25%. In Australia at the same period of time, they're down to about 2.12%. So basically 13 basis points difference. The reason for that is more so on the Australian side of the equation than in New Zealand. New Zealand's been basically hovering at that 2.25% for a number of years now, whereas Australia, there's been increased competition in the kind of the corporate sector, fueled by, I guess, the lack of growth in the first half in Australia of their years. But also, interesting, the Australian banks are now going through what the New Zealand banks went through 3 or 4 years ago about improving their liquidity to ensure compliance with kind of global ratios and so forth. So there's been greater demand for deposits in the Australian banks than there has been in New Zealand. And that's also come through when you see the funding. Funding growth of about 9% for retail deposits in Australia versus kind of the consistent 2 to 3% growth that's occurred in the last 6 months.
Now, your report covers the period up to the end of September last year, so obviously that was just as the Reserve Bank brought in its loan-to-value ratio restrictions on home loans. So I guess you'll be covering that off in your next report, but in terms of the impact that is having, what are you seeing, what are you expecting it to have?
Yeah, it's quite interesting, but what has emerged as a result of the speed bumps that have been put in is there's 2 pricing points now, and that's just natural. Those that have an LVR ratio of in excess of 80% will have to pay more than those that are below 80%.
This is the borrowers.
The borrowers, yes, definitely right. Also, the banks have to hold more capital for that higher LVR borrowings. So that's emerged, 2 pricing points, and because of the restrictions, you're going to have to pay a bit more because of scarcity of supply. On the other side of the equation, also seeing what this will mean is clearly there's going to be lower growth in that category, and that will make people, I guess, forced to save harder for the deposits. But it also means shopping around to get the best deal you can when you're in excess of 80%. It's a lot difficult. Versus someone who has a LVR below 80%, well then that's good times for you because you are now a high demand customer and you will be able to in the best position to negotiate the best deal for you personally. So
from the bank perspective, are these LVR restrictions going to reduce their margins?
Well, from a margin point of view, you're going to have a push and a pull. You expect the net interest margin to increase for the likes of those above 80%, but increased competition below 80%. So where it will kind of pan out is be interesting to see. However, what we do expect though is the net interest margins to kind of hover around that 2.25% range, and there'll be swings and roundabouts, ups and downs, but we'll be there or thereabouts.
You've also highlighted that the returns on equity at the big banks have risen, I think, about 100 basis points up to 14.8%.
Yep.
Now, you've noted that there are a number of levers they can pull to maintain this increase, but they could be restricted by competition from doing so. So just firstly, what levers could they pull? And are we talking about this sort of LVR competition as things that will restrict it?
Yeah, I guess return on equity is an interesting percentage to look into for the banks. There's two parts of the equation is basically their income versus the expenses. What we've seen with the expenses recently is that's basically flatlined, and so there hasn't been any material change in the expenses over the last 2 periods. So you're left with how can we generate more business, and I guess it is looking at the income, and it's also ensuring you've got the right capital base. Are we holding too much capital? Now the banks themselves are very strong with their capital positions. Their total capital ratios are in excess of 12%, well above the regulatory minimums. So again, it's basically trying to get the mix right from a bank, but we have seen the return on equity lift, as you say, about a percentage point over the last 6 months. What will be interesting to see, again, looking forward, is whether that will continue to lift, or whether actually we're at a kind of a pricing point that this is where I guess the market is, because there is competition. The household lending market is fiercely competitive, and it needs one player to I guess commence again another mortgage war, and that will definitely impact I guess the margins and I guess the return on the equity for the banks.
You've hit on an interesting point that I've noticed in bank results for the last couple of years, which is that they have been remarkably good at either reducing their expenses or keeping them very, very flat. How are they managing to do this, and how long can this continue? Because they are facing quite a lot of IT investment, most of the banks at the moment. Yeah,
the costs themselves, banks go through different cycles of change, and if we rolled back a year, I know there was the simplification program for one of the banks that incurred a lot of cost for them. That has now been spent, and now it's I guess business as usual. So it is making sure that money is well spent. The regulatory change that's occurred, we've gone through a lot of that change with the Basel III, AML, FATCA and so forth. So I think where we've got to ourselves is now is a bit of a stable platform. It is a focus point for the banks, of course, cost, because when you're in a low growth environment, and when you talk about the growth here, it's kind of keeping pace with GDP or thereabouts. So it is not in excess of GDP, which is an important point to note, that you need to focus on your costs to make sure they stay in check. Now, cost of income, you spoke about that earlier. The New Zealand banks have improved their cost to income ratios than the Australian banks. Again, that is a function of, to some degree, the New Zealand banks going through their changes previously. I know the Australian banks have had a bit of a spend on IT recently, so that's pushed these up. But also, from the New Zealand banks' perspective, their other income is, because we've got a lower number, the other income does swing the cost to income ratio quite significantly. So there is a bit of volatility that occurs period on period, but when you look at them kind of in a linear fashion, they're not too dissimilar.
Now, another really interesting thing that you've highlighted in your report is that it was the first time since 2009 that banks actually lent more than they took in deposits, so it's sort of 4+ years.
Yes.
That's really interesting. Obviously, deposit funding has been, I guess, a real key factor for banks in the last few years, with the core funding ratio being introduced by the Reserve Bank, and obviously lending growth has been low. But if this deposit growth can't keep pace with lending growth, where are the banks going to turn? Are they going to go back to borrowing money offshore? Yeah,
so you've touched upon a point there. What is quite interesting is we're slightly a net borrower for the current 6 months. Where can the banks go? Well, of course, they've got the retail deposits, and again, with potential rising interest rates, there could be an opportunity there to increase those deposit rates to become more attractive when you compare it to the equity markets, which have been performing strongly over the last 12 to 24 months. The banks themselves, yes, they can access the wholesale markets offshore. We have seen a slight reduction in reliance, down to about approximately a third of banks' borrowings now is from offshore. But clearly there's also the domestic markets where they can actually do local bonds and so forth, or other wholesale raisings domestically to mitigate any increase in lending growth that does occur.
So every economist and his or her dog is expecting the Reserve Bank to increase the official cash rate starting from March. Yep. If that does indeed happen, what impact is that going to have on banks and their customers, I guess, in terms of the mortgage rates, deposit rates, bank funding costs, and indeed bank margins?
Yeah, so there's been a lot of said in the media about forecast interest rate rises. Clearly that's going to have upwards pressure, both from a lending rate but also a deposit rate. Clearly the banks don't fund their book purely on OCR alone, so that will have, as I say, an upward influence. We expect, though, that if rates increase, deposit rates will similarly increase, and that may mean that they'll become slightly more competitive in the market against other returns that can be offered. However, we do expect the net interest margin to kind of be maintained within the range that is currently in place. And of course, it's a good opportunity again for further competition in the market to ensure that any upwards lift in interest rates and potential upwards lift in margin can also be held down by, I guess, the competition amongst the banks.
Okay, I guess on the other hand, if for some reason the Reserve Bank doesn't increase the official cash rate, barring any calamity overseas and the New Zealand economy just continuing on its current trajectory without an increased OCR, what sort of year do you think we might see for banks and their customers in that case? Yeah,
so the banks themselves, I guess what they need to try and do now is build upon this momentum that they've generated over the last 2 years. So clearly if there's a delay in interest rate raises, well, that's good for the borrower. That means these historically low interest rates will be here for a lot longer. I suspect what that will also mean, though, is how the borrowers out there will be pricing and sticking with interest rates at the short end of the curve and not trying to fix them for a long period of time. It will not negate, though, the competition that's out there to grow the books, because at the end of the day is when you're in a low growth environment, if there's no organic growth going on from an economic point of view, is the only way you can do is to try and gain share is actively targeting customers. So interest rates stay low, I guess the competitive forces will stay there, and you'll see the banks still grasping to attract customers to ensure that they continue on that momentum that they've generated over the last 2 years.
Well, thanks a lot for that, Sam. That's Sam Shuttleworth, who's a financial services partner at PWC, and I'm Gareth Vaughan at interest.co.nz.